Yes.
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 So Chancellor Yamada, Chancellor Kwon, Professor Matsushita, Dr. Yu, Professor Yoshino, our distinguished speakers, ladies and gentlemen, good morning. And thank you very much for joining this webinar, which is on financing COVID-19 recovery plans using the capital market. It's a pleasure to have you all here today. So this webinar, as it's informed earlier, it's a joint event of Tokai University and Yonsei University. So today we have distinguished speakers from academia, from financial sector, and also from multilateral development banks to discuss about financing recovery plans. So due to the COVID-19 pandemic and the economic downturns, which is coming from the lockdowns, governments are in a tough economic situation, in tough fiscal situation. So in the both revenue side and the expenditure side, we are observing a drastic change. In the revenue side, because of these recessions, it is not possible for the governments to achieve the tax revenue targets. And on the other hand, in the expenditure side, due to the increased healthcare expenditures, protective expenditures, and also the transfer payments that governments need to provide, the expenses increased a lot. So that is making the situation very tough for governments in different countries. This is the reason that new forms of financing, especially using the capital market and the green bonds and impact bonds that we are going to discuss today are needed. And in this webinar, we would like to, we have distinguished speakers to talk about the opportunities that the capital market, especially bonds, can provide for the governments for solving these financing difficulties will be discussed, and the challenges. And the objective is to provide practical policy recommendations to governments in both developing countries and developed countries, and also to international organizations and so on. So for those who don't know me, my name is Farhad Taghizadeh. I'm from Tokai University, and it's a pleasure to moderate this event today. And so with this background, I would like to invite Professor Yamada, the Chancellor of Tokai University, and after that, Professor Kwon of Yonsei University for kindly opening this event. And for the participants and panelists, I just shared the link of agenda of this program and also the biography of the speakers or distinguished speakers in the chat panel in the right hand side, that you can see it. And this event is we are going to wrap up this event at 12:30 Japan and Korea Standard Time. So first we have the opening remarks and then keynote speech, and then we will have about 7 presentations, and after all, the discussion. So Professor Yamada, Chancellor Yamada, please, floor is yours.
Thank you for kind introduction. Good morning, Chancellor Min-Yong Wong, Professor Matsushita, Professor Yu, Professor Yoshino, distinguished guests and colleagues. It gives me a great pleasure as the Chancellor of Tokai University to welcome you to today's workshop. This is the first time to have a cooperative event between Yonsei University and Tokai University. I'm delighted to hold this event today with Yonsei University. I would like to thank all persons who made it possible to have this significant event. As a matter of fact, I want to via Seoul to taste delicious Korean barbecue last night. However, I couldn't. So I hope to see you in the near future face-to-face. Today's theme is financing COVID-19 recovery plan and capital market, application of the green bond and impact bonds. It is a very timely subject under the coronavirus crisis now. Due to the COVID-19 pandemic, more or less, all governments in the world have to spend a significant amount of support fund for medical care, business recovery, market stimulation, purchase of national bonds, and so on. The government also needs to invest directly in the society in demand. However, the government funds are limited, especially at this time. We may utilize system of social impact bonds now. The bond may efficiently help and solve the facing problems in the community in need in the communities. At the same time, we have to keep considering sustainable development. In order to produce environmentally friendly energy, we have to invest in clean energy. It is a tough time for the government to invest in the future now. However, to build a forward better world, we have to keep investing in sustainable development such as green bonds. I believe this is an obligation for our generations. I'm confident that today's workshop will allow all participants to deepen their understanding of investing and financing in a social benefit and sustainable development. I hope this event brings further the academic and the research collaborations between Yonsei University and Tokai University. Thank you very much. 감사합니다.
Thank you very much, Chancellor. So next, I would like to invite Chancellor Kwon for kindly opening this webinar, please.
Good morning, everybody. It rained heavily in Korea last night, and now it dies down. There is lots of damages and casualties due to heavy rain in these days in Japan and in China. I wonder how the weather is in Japan. Anyway, let me introduce myself. I'm Myung-Jun Kwon, the Chancellor of Yonsei University, Marke campus, and professor at the Economic Department. It's a great honor and privilege for me to give opening remark today. Currently, we are experiencing unprecedented crisis by COVID-19. Look back upon the past economic crises. It has changed our lives dramatically and substantially. With the Asian financial crisis in 1997, Korean economy finished 30 years of a high growth period and has entered into medium-level growth path after financial and corporate restructuring, and this has changed a lot our economy and society. With the global financial crisis in 2008, the global economy has yet to recover its pre-crisis levels, but it is picking up bubbles and entering a balanced growth level. This time, COVID-19 crisis has fundamentally shifted our world and society in ways not seen in generations, leading to a variety of fundamental changes, and is already having a profound effect on our daily lives. However, I think a silver lining of the post-corona world exists in the idea of a crisis always containing opportunity, as we had experienced before. In this sense, I think today's webinar will be also a good opportunity to see how we cope with the current crisis. In the wake of COVID-19 pandemics, I would like to consider two important issues: increasing fiscal burden and the environmental impact for the future generations. In the short term, fiscal deficit increased as the country responded to unprecedented health crisis and unemployment shocks. The great expansion of liquidity by unprecedented monetary policy and the fiscal policy is a prominent feature of the COVID-19 era. During the 2008 global crisis, particularly in the United States, central bank alone struggled to solve the macroeconomic problem caused by the recessions because fiscal policy was difficult to use properly due to political reasons. But this time, the situation was so urgent that we did not have enough time to discuss fiscal soundness. The unprecedented crisis opened the door to fiscal policy. However, if the fiscal policy is formulated in a populist manner and funds are used unproductively, it is a considerable burden to future generations. One way to overcome this problem is to use not only taxpayers' money, but also capital market resources when deciding on financial support projects. COVID-19 pandemic has impacted the environment in an intriguing way, causing global health crisis and forcing economies to slow down due to stricter lockdowns. COVID-19 is affecting environment as well as our daily lives. The CO2 emissions and the human mobility have been reduced, which temporarily improve our air quality. Therefore, COVID-19 pandemic will offer lessons and opportunities leading to environmental improvement. Against these circumstances, it's very meaningful to see how we finance COVID-19 recovery plans through capital market by using green bond, social bond, and sustainability bond for sustainable economic growth. I'm very pleased to see that mutual understanding and friendship between two universities are deepening further through active exchanges. In this round of COVID-19 webinar, participants will have in-depth discussions on important issues such as financing COVID-19 recoveries plan and capital markets. I hope intellectual exchange in this webinar will help all participants get insight for mapping out a blueprint for fighting COVID-19 through the capital market. Based on mutual trust and friendship, Yonsei and Tokai will set up cooperation to facilitate academic exchange in Korea and Japan, and in furthermore, Asian regions. And hopefully, this event will make the first step toward even further cooperation in this area. Before I finish, I would like to appreciate Tokai University for co-hosting this event. Also, let me share with you my deepest respect for those who made a passionate effort to this event. Thank you for your kind attention.
Thank you very much, Chancellor Kwon, for your opening remarks. So next, we will have two distinguished keynote speakers that I would like to introduce them. So our first keynote speaker is Professor Kazuo Matsushita. Professor Matsushita is a Professor Emeritus of Kyoto University, and presently he is a Senior Fellow at the Institute for Global Environmental Strategies. In addition to that, he is the co-chair of Climate Change and Environmental Task Force at T20 of Saudi Arabia. And he was the lead co-chair of Climate Change and Environment Task Force of T20 Japan that organized last year in Japan. Professor Matsushita is among the global prominent experts in the field of environment. So it is a pleasure to have Professor Matsushita here today, and please.
Thank you, Farhad-san, for your kind introduction. Professor Kiyoshi Yamada, Chancellor of Tokai University, Professor Myung-Jung Kwon, Chancellor of Yonsei University, Mirae Campus, distinguished participants, ladies and gentlemen. It is a great pleasure and honor for me to have the opportunity to give a keynote speech on this important occasion of Yonsei University and Tokai University joint webinar on financing COVID-19 recovery plan and capital market. The title of my presentation is From COVID-19 to Green and Healthy Recovery. Next slide, please. Yeah, many human lives and health have been deprived of by the COVID-19, and the economy has been seriously damaged, which is comparable to the Great Depression. As a result, our lives and livelihood have changed dramatically. Currently, more than 16 million infections have been confirmed worldwide, with at least 650,000 fatalities. Our health and safety lives depends on a healthy global environment. However, the global climate crisis and widespread deforestation, along with economic globalization, have shattered the equilibrium of natural ecosystems. This has increased the risk of contact with new unknown viruses. According to UNEP, United Nations Environment Programme, new infectious diseases occur every 4 months, 75% of which are of animal origin. Factors of infectious diseases transmitted from animals to humans include deforestation, intensive agriculture, illegal animal trade, and climate change. If these factors are not resolved, new infectious disease will continue to occur. And with the rapid movements of people and goods due to globalization, infectious disease spread quickly throughout the world. In addition, there is a close relationship between air pollutants and the COVID-19. And also, there are research results that say those exposed to air pollutants, such as particulate matters, for a long time have a higher mortality rate due to COVID-19. We need a high level of crisis awareness and effective measures for both problems. Next slide, please. The COVID-19 crisis has shown the importance of accurately understanding and preparing for risks based on scientific knowledge. However, there are still many scientifically unknowns regarding for COVID-19. At the same time, IPCC, Intergovernmental Panel on Climate Change, reports that the damage caused by climate change is far greater and longer than that of the COVID-19. To prevent things from deteriorating any further, it is essential that we learn from the crisis and act quickly to shift to a carbon-free society. Both the COVID-19 and the issue of climate change are related to the survival of humankind and an important issue that the international community should work together on. We have to seek for an economic and social system that a pandemic is unlikely to occur, and at the same time that can avoid the crisis of climate change. Next slide, please. In order to cope with the COVID-19, various measures have been introduced in many countries to restrict economic activities and movement of people, such as city lockdown. As a result, emissions of air pollutants and greenhouse gases decrease in the short term. NASA released a satellite image March 1st, showing that the pollutant has dropped significantly in China, and saying that the stagnation of economic activity due to the new coronavirus epidemic would be at least part of the cause. This picture slide shows the improvement of NO2 pollution by comparing January and February of this year in China. However, past experience has shown that such environmental improvements are temporary, and that when economic activity returns to normal after the pandemic, emissions of pollutants and greenhouse gas also rebound. On the other hand, there is a possibility that the economic stagnation and contraction due to COVID-19 may delay the implementation of climate change countermeasures. At the same time, changes in economic activities and daily life due to measures against COVID-19, such as telework, telecommuting, online meetings, etc. These are new lifestyles and work styles with low environmental impact. Therefore, they could be encouraged and diffused after the corona. Next slide, please. Click 2 or 3 times. Yeah. Okay. One more click. 2 more click. Yeah. Okay. After the past global recessions, such as the first oil shock, second oil shock, the collapse of the Soviet Union, the Asian financial crisis, and the Lehman shock, greenhouse gas emissions decreased, but they recovered shortly after. On the right side, IEA projects 8% of CO2 emission decrease in 2020. However, in order to attain 1.5 degree target under the Paris Agreement, CO2 emissions should be reduced more than 7% every year. Therefore, post-COVID-19 green recovery measures are critical to attain the Paris Agreement, the target of Paris Agreement. Next slide, please. Looking at the CO2 emissions that cause climate change in China, this is the case in China. During the lockdown of Wuhan, from the beginning of February to the middle of March this year, it decreased 25% in the green shaded area, but it increased by 5% in May, and rebound has already occurred. Factors such as restart of coal-fired power plants and revival of carbon-intensive industries, such as cement and steel, have been pointed out. Next, please. Next, please. Yeah. Amidst the worldwide problem of the COVID-19, carbon dioxide emissions have decreased worldwide, and air pollution has improved. There is a global debate about how to make this a sustainable and healthy economy, rather than ending it with a temporary phenomenon. It is called green recovery or building back better. In addition, the World Health Organization announced WHO manifesto for a healthy recovery from COVID-19. Currently, governments are proposing mid to long-term economic measures in parallel with implementing emergency measures such as income and leave compensation in order to recover from the COVID-19 crisis. The scale of economic measures aimed at recovery from COVID-19 recession is historically the largest, and will greatly affect the future social structure of each country. Therefore, the content of economic recovery measures will be critically important. The world leaders, including the Secretary General of the United Nations and CEO of global companies, advocate that the goal is not to restore the original conditions, but to restore to a stronger and sustainable, better state. The Secretary General of the United Nations proposed that the economic measures should be an opportunity to realize a decarbonized society. Also, the Executive Director of the IEA, International Energy Agency, stated in his speech that putting the expansion of and transition to clean energy at the center of recovery from the COVID-19 crisis was a historic opportunity, and he organized the IEA Clean Energy Transition Summit. Next slide, please. European Union is leading through European Green Deal. Despite the recession caused by the COVID-19, the European Union is firmly committed to the European Green Deal, which is the growth strategy of the EU that promotes job creation and innovation while harmonizing economies and production, consumption activities with the earth, working for people and reducing greenhouse gas emissions. The South Korean ruling party won the general election in April 2020 with a manifesto including the Korean version of the Green New Deal, the first carbon neutrality in Asia, and withdrawal from coal-fired power plants. In the United States, the presidential election is scheduled to be held in November. Democratic Party candidate Joe Biden has announced a policy plan to invest $2 trillion in global warming countermeasures and infrastructure investment in 4 years, and to reduce greenhouse gas emissions from the power sector to zero by 2035. In addition, he will seek to revamp infrastructure such as transportation networks and promote the use of electric vehicles. He incorporated the idea of Green New Deal policies within the party, which was advocated by Bernie Sanders and Ocasio-Cortez. Next slide, please. Next, please, yeah. Japan's Minister of the Environment, Mr. Shinjiro Koizumi, proposed a ministerial level online platform for tackling climate change and environmental conservation in the recovery from the COVID-19. This platform is scheduled to be launched in September and will post information on COVID-19 recovery and climate change and environmental measures submitted by each country. But how are countries actually responding to the growing demand for green recovery? Actually, the fossil fuels win big, according to the Energy Policy Tracker. The Energy Policy Tracker was initiated by 14 think tanks, including ITIS, Institute for Global Environmental Strategy in Japan, and IISD, Institute for International Sustainable Development in Canada, and which was launched on July 15th this year. And its aim is to verify energy spending in each country from the green recovery viewpoint. And according to the first survey for G20 countries, at least $151 billion were allocated to support fossil fuels, while only $89 billion were allocated for clean energy. Next slide, please. So what is the Green and Healthy Recovery Plan? Measures to address climate change have aimed to encourage a shift to economic systems that can contribute to human happiness by making a better quality of life possible for more people through a switch to sustainable energy, higher energy efficiency and resource efficiency, and lifestyle that are less dependent on material consumption. Increased public spending to address climate change should be regarded as an investment in our future. Indeed, it is quite likely to bring greater economic returns in the decades to come through investment in sustainable infrastructure and the development of new technology. But if reconstruction policies go no further than conventional economic stimulus packages like the ones we have seen in the past, including support for industries dependent on fossil fuels, bailout for the aviation industry, and increased spending on new construction projects, any success they achieve will be short-lived. Although they may succeed in reviving the economy in the short term, in the longer term, it is difficult to see how such policies will improve the prospects for substantive structural change or a shift to a carbon-free society. This is why any long-term economic recovery policies designed to lift the economy out of the pandemic-induced recession also need to contribute to the transition to the decarbonized society and the realization of the SDGs. At the same time, we cannot afford to go back to the way we were before. We need to move forward toward a new society built on a new normal. It is also likely that the rampant economic globalization may be re-examined from the perspective of increasing resilience of local communities, countries, and the world against the threats of such as pandemic and climate change. Next, please. So, in conclusion, green recovery is an opportunity to recreate the existing economic system rather than simply restoring it. It is necessary to introduce policies in all fields of society, aiming for a transition to a sustainable carbon-free economy through the shift of technology, social systems, and lifestyles. Financing for green recovery, which is the subject matter for this webinar, is particularly important, which is a key to turn the global economy into a climate resilient, a climate and people's responsive system. Coordinated actions for Green New Deal is the best way to safeguard meaningful jobs, protect people's livelihood, and reset economic priorities towards creating a more livable planet. Learning the lesson from COVID-19 damage and promoting a rapid transition to a carbon-free and sustainable society is the direction that the world should aim for. The transition means transforming the entire social system, including finance, economy, society, technology, institutions, and lifestyles, into a carbon neutral and sustainable way. Thank you very much for your kind attention. Thank you very much for your kind attention again.
Very much, Professor Matsushita, for your informative keynote speech. I appreciate it. So next, I would like to invite our second keynote speaker, Dr. Kwang-Yeol Yu, who is presently a visiting fellow at Asia Research Center of Yonsei University. Professor Dr. Yu is the former first senior deputy governor of Korea Financial Supervisory Services, FSS, which is the supervisory organization in the financial sector of Korea. And he joined Korean government in 1986. And during this long term, he holds several senior level positions, including the Director General of Ministry of Strategy and Finance, and also senior level positions that the last one was the first senior deputy governor at FSS. In addition to that, he holds positions at international organizations, including the economist position at OECD. And it is a great pleasure for us to have Dr. Yu today. So Dr. Yu, floor is yours, please.
Thank you very much, Professor Farhad, for the introductions. And I also like to thank you for the organizer and also discussants and participants of this seminar. It is my honor to have a chance to participate in this timely and important international webinar on COVID-19 and capital markets. Indeed, as Professor Matsushita mentions, and also Professor Yamada, Chancellor of Tokai University, mentioned early in the beginning, I think that the economic and financial impacts on COVID-19 is much wider and deeper than we initially expected. And the crisis is still ongoing. While the numbers in financial markets across the world at this point look fine, there is no complacency among policymakers and central bankers and regulators, in part due to the observed discrepancies between financial numbers we see and fundamentals underlying those numbers. And for the purpose of this seminar, I will limit my remarks to how Korea's capital market are related and responding to COVID-19 crisis. Next page, please. This is table of contents. Next page, please. Since 2008 global financial crisis, Korea's financial market underwent several fundamental changes. Despite the tightening of macro-prudential supervisions of banking and non-banking activities and stricter conduct supervisions, the role of capital markets as players has been growing in Korea's overall financial markets. Over the decades, the assets under management and number of security companies and asset management companies have been growing much faster than any other financial sectors. In particular, we witnessed a dramatic rise in the share of private equity investment, offshore investment, and alternative investments. At the same time, over-the-counter derivatives and derivative-linked securities play a more important role in capital markets. And also shadow banking activities focusing on real estate operation continues to rise as security companies, on the back of the liberalization of our regulations, takes more risk to make money. However, their funding structure remains still short-term and reveals potentially dangerous problem of currency and funding mismatch. In a nutshell, capital markets become a major conduit for risk spillovers compared to previous episode of the economic crisis in 1998-2008. Previously, banking sector was the main source and origin of the problems because they are the one deeply involved in financial intermediation in Korean financial and real markets. But this time, compared to banking sectors, now capital markets play a more important role in terms of their impact, in terms of their role in mitigating the risk or in amplifying the risk. And next page, please. Let's have a brief look at the Korea's capital market in recent periods. As you see that last year, Korean economy registered 2% growth. And we see that early this year, COVID-19 crisis and further clouding already uncertain outlook for Korean economy in 2020. At the moment, OECD projected Korean economy's economic growth this year is minus 1.2%, and IMF has a negative 2% rates. Of course, compared to other countries, in part thanks to Korea's strong preventive measures against COVID-19, we have less negative numbers, but there's no complaints about it. So we have close look at the development of the markets and real economy. and indeed internal, external effects arising from COVID-19 already impacting capital markets and their financial markets severely. Next page, please. Now turn to each segment of the capital markets and how COVID-19 affects them. When it comes to stock markets, it bottomed in mid-March this year and continues to bounce back on the back of bold measures taken by the governments and central banks. Korea joined other countries in taking firm and drastic extraordinary steps to address COVID-19 driven financial difficulties. But as you see on the graph, unlike previous episode of the economic crisis, now real investors are outbuying foreign investors with high expectation of bullish markets. Previously, the main driver of the economic crisis was the foreign investors retrieving from the Korean markets, stock markets, but this time, domestic real investors are buying much more than foreign investors retreats. Of course, but this weird phenomenon is very difficult challenge, raise a difficult challenge for the policymakers and regulators, because without strong fundamental, economic fundamental that's supporting the financial numbers, it cannot continue like this. Next page, please. And look at the bond market and commercial paper, short-term direct markets. And bond markets and commercial paper markets continues to grow in recent years, but suffered from also severe stress and credit crunch and this April as dim prospect for corporate sector's performance in coming months. As you see on the right side panels, in April, we witnessed the negative net corporate bond issuance on the back of market crunch and big concerns about the spread of the COVID-19 virus. However, it's coming down pretty soon, in part thanks to the government established bond market stabilization funds and key industry stabilization funds, also managed by the Korean Development Bank, Korean policy banks. Or central bank also injection their liquidities with the back of the government's guarantees. And those two schemes, the market stabilized in recent months. However, market remains very fragile and weak, and the low-rated issuers suffer from the redemption risk, as the outlook again for real economy is still bleak, depending upon how serious COVID-19 driven impact will be. And also, we'll see they will gradually witness the impacts of real sectors from the COVID-19 crisis. It comes from financial sectors, and then we see that numbers are coming up in real sectors. Next slide, please. The developments of the derivative linked securities market is much more complex and problematic in this episode of economic crisis. As you see on the left-hand side graph, the issuance of ELS, DLS rose sharply in recent years in search for high yields. And therefore, its underlying assets are mostly foreign stock index such as Euro stocks, S&P 500, and HSCI and Nikkei 22. And in-house hedging takes a growing share to 56% in 2019. Of course, this situation reflects the situation that we experienced extended period of low growth periods, and people are searching for hires, and financial companies have their own incentive to sell high yield, high risk products. But in the case of the economic problems, and then underlying assets suffer from loss, and we see that high risk will turn over. Just previous slide, please. And as the COVID panic early this year sent the stock market and forex market into downwards spiral, Korea's security market in March faced margin calls on offshore derivatives due to the drop in prices of underlying assets. And to fulfill margin call related obligation, security companies rushed to borrow from domestic short-term markets and exchange it to dollar market and to buy in the forex market. This caused a sharp squeeze in forex market and swap markets, and the sharp rise in borrowing costs and credit crunch in short-term markets. Again, that gave a lot of stress and problems for the government and regulators at that time. And there is a risk if the situation is not duly controlled, there is a risk then certain security company made bankrupt, and that created a lot of economic instability to the Korean's financial system and then later on in real economy. And furthermore, how to address the mis-selling of the risky financial products and the lack of the due diligence by sellers now a main controversial and social problems and Korean financial world and society face. And it will be continuously the main source of the financial risk that leads to distrust and even worse reputation of the financial market and industries. Next slide, please. As I mentioned in the beginning, the change in the fund market was also significant. You see that now private equity funds and offshore funds and alternative investment takes important share of their investment and enlarging the risk when the risk comes realized, especially external sides. And as the cost of the COVID panic develops, the price of offshore alternative investment product fails, and even they face the failure not to redeem. So now the fund market becomes an important channel through which the external internal risk can be transmitted to the domestic financial real markets. Next slide, please. Having said what have we experienced in recent periods, we as regulators and in close cooperation with the governments and seriously takes the issue of the capital market problems and will take appropriate measures in due process. Of course, there is still concerns over more volatility stemming from the outside, such as the second wave of COVID-19, which is already taking place. So we think that we need to strengthen the monitoring of the development in major stock market and foreign investment flows, and we implement the measures to curb excessive volatility if needed. We also need for the brace for credit crunch that may arise owing to lower grade corporate debt as investors continue to prefer low risk assets amid economic uncertainties. Again, we have to monitor less creditworthy companies and vulnerable industries and need to cope with the demand hike with bond market stabilization funds. If the market volatility returns, there is risk. Clearly there's a bubble in the financial market at this point. So if the bubble breaks up, and that will create a lot of problems. We also need to think about the measures to supply funding to less creditworthy companies through primary CBO and etc. We also need to monitor and conduct company and industry restructurings. However, it's not an easy task. In the case of economic downturns, that's a very difficult task, but we have to really live with that important agenda going forwards. And we have to oversee stock market risk, bringing contagion to domestic market. We have witnessed early this year with the surge in ELS issuance. We need the measures needed to counter heightened systemic risk and deteriorating soundness of the security companies. Next page, please. Again, private equity markets need attention as redemption requests surge due to sluggish returns from COVID-19 and deteriorating investor confidence. So we need to restore investor confidence through stronger inspection of the PEF, while measures will be taken to protect investors in high-risk financial instruments. We also need for the risk management to prevent concentration of offshore alternative investment funds on certain regions and asset class. Asset management companies, the self-risk management and internal control capability are needed to reduce investment risk of individual offshore alternative investment coming from the external shocks. Again, finally, the emerging risk to the financial stability stemming from the growing shadow banking in capital markets, especially real estate market. Now we're thinking about not only just monitoring the shadow banking activity, try to introduce certain measures to have a much more prudential regulation relating to the real estate market investment at its spillovers. Thank you for your attention. That's the end of my presentation. Thank you.
Thank you very much, Dr. Yu, for your insightful and informative presentation about the supervisory aspect and also what governments need to do in the current timing in order to mitigating the systematic risk and the financial risk which is existing in the financial sector. So before we go to the next session, which is the presentations by our distinguished speakers. So let's have a photo, let's have a group photo, and after that, I would like to invite our first speakers. So are you ready? I will make a screenshot. 1, 2, 3. Okay, thank you very much. So, okay. So now we are moving to the main part of the webinar that we will have 7 presentations by distinguished speakers here. So the first presentation is by Professor Naoyuki Yoshino. Professor Yoshino is the Professor Emeritus at Keio University, Japan. Currently, he is Director of Financial Research Center, Financial Services Agency Institute of Government of Japan. In addition to that, he is advisor to T20 G20 Saudi Arabia and the lead chair of T20 G20 Japan. And in addition to that, he is a visiting professor at National Graduate Institute of Policy Studies, GRIPS. Professor Yoshino is the former dean and CEO of the Asian Development Bank Institute that his presentation is on financing sustainable development goals amid COVID-19. Professor Yoshino.
Okay, thank you very much. So can you show my screen?
Yes.
Okay, thank you very much for inviting me today. I would like to talk about optimal portfolio selection and also currently SDG investment and green investment. Please go to next. Recently, there are many ways to say ESG investment, SDG investment, green bond, and green banking. Today's discussion is current definition of these criteria may distort optimal portfolio selection. So that is my one message. Then second message is we have to clearly define what is green bond and what is SDG investment. Otherwise, that will keep on distributing the portfolio allocation in not optimal way. So please go to next. There are 17 goals SDG. Professor Matsushita had mentioned. Please go to next. And these 17 goals have so many different objectives: education, poverty reduction, environment, and so on. When the United Nations came to Japan, those who had created this SDG told me why there are so many different 17 objectives. First, United Nations start ESG investment, environmental and sustainable goals. Then many people thought ESG is not my territory, my real research. So United Nations thought we have to include all the topics which everybody think this is my goal. That's why SDG has 17 goals, which contain so many different topics. Please go to next. Then coming back to energy point, average temperature is increasing. Next, ocean level is also growing. There are so many indicators, and please go to next. And my proposal today is going to look at the current SDG investment in comparison to the optimal portfolio allocation. Please go to next. So our paper is finance research letters and talking about theoretical model background in this paper. Please go to next. And there are many consulting firms who are talking about SDG or ESG. Please go to next. For example, this is KPMG. They have pointed out 4 important criteria for SDG: demography, economic growth, collaboration, and so on. Please go to next. NRI, Nomura Research Institute, they have another 4 criteria for SDG. Please go to next. And PwC, they have another 4 goals: leadership, employee engagement, reporting, collaboration. So if you look at the consulting firms one by one, each consulting firm has different criteria for SDG or ESG. And please go to next. Then portfolio investors, institutional investors, they are hiring one of those consulting company how to reallocate their portfolio allocations. Traditionally, we are looking at rate of return and risk. And please go to next. But now we have to add one more component in addition to rate of return and risk, which is either SDG or greenness index. And please go to next. And it is called the multi-factor model. So here, RT is the rate of return and sigma t square is risk. And now all the investors has to add either SDG or greenness in their portfolio selection. And please go to next. Then traditionally, point E was the optimal point. However, now they are looking at one additional component, either SDG or greenness. Suppose there are two investments, point E and point F. And point F, if company has higher score of SDG, then traditionally the allocation was point E. But if additional component of SDG is taken into account of, then point F will become the optimal point for the allocation. However, which consulting company institutional investors ask, this point F is different because scores of SDG measures are different. So that means current allocation of portfolio will be distorted by different criteria made by consulting companies. Please go to next. Then what is the best way to bring them back to optimal portfolio allocation? Then conclusion, the best portfolio allocation could be achieved by taxing all the waste, CO2, NOx, plastics, same tax rate to all over the world, to all the companies. Then please go to next. Then once we tax each company based on their exposures, please go to next. Exposed return after subtracting these tax. Then investors can look at after tax rate of return for each companies. Then each investors do not have to take into account of SDG or greenness index because it is automatically adjusted by global taxation. Then all the portfolio investors can come back to rate of return and risk as they are doing. So please go to next. So this is bring back from original point E by taxing all the companies based on their waste, then point F will be automatically achieved. So in other words, current allocation of SDG or ESG investment based on different criteria made by consulting company will bring distorted portfolio allocation. So one of the best way is globally the same tax rate to all over the world will bring back to the original portfolio allocation. Please go to next. The same thing can be applied to green bond. Green bond, when I looked at, there are many institutional investors who define green bond. In Europe, there are about 10 criteria for green bond. If some of them are satisfied, they can issue green bond. However, some green bond, 80% green, 20% gray. As long as their criteria matches their definition, they can be called green bond. Some green bond, 60% green, 40% gray. But if that component satisfied these criteria, that can be called green bond. The same thing can be applied to green bond. Current definition will distort the optimal portfolio allocation. Please go to next. In Europe, there are many green bonds has been issued, and US has also issued huge amount. And Japan is very small because I oppose to Japanese government to issue green bond because Japanese government bond criteria is not definitely clear. So that's why Japan looks like very small because I objected to the issue of green bond in Japan. Please go to next. In Sweden, they are issuing short-term government bonds. This is mainly for banks. In Finland and Denmark, they are investing long-term green bond for insurance and pensions. So in Europe, green bond is very popular. But as I said, one of them satisfies one criteria, they can call it green bond. But it is not definitely 100% green, but there are so many different kinds of green bond. Please go to next. So that will distort the allocation of the optimal portfolio because greenness index is not unique. Lastly, please go to next. It is often, again, green banking is also introduced some countries. If banks are lending money to green-related sectors, then they can call it green loans. Again, this green loans is not clearly defined. 80% green, 20% gray. That can be called green bond. And 70% green, 30% gray, they are called by green lending. So I think greenness or SDG are very important. However, unfortunately, current allocation of those portfolio will distort the optimal portfolio allocation. And that is my message. So taxing all those waste will be the optimal way and the best way for bring them back to optimal portfolio allocation. And thank you very much for inviting me today.
Thank you very much, Professor Yoshino, for your informative presentation on optimal portfolio allocation of the Sustainable Development Goals, which is very essential, especially in the current timing. So our next distinguished speaker is Mr. Takashi Hongo. Mr. Takashi Hongo is a senior fellow at Mitsui & Co. Global Strategic Studies Institute in Japan. And he's a senior expert and analyst on policies for climate change and energy. And he's currently member of several government committees on this topic. And before joining the Institute, he worked for Japan Bank for International Cooperation, JBIC, and his position was a special advisor to governor. And it is a great pleasure for us to have Mr. Takashi Hongo. Mr. Hongo.
Thank you very much. Could you show my slide, please? So today I would like to introduce first what happened now under COVID-19, and then move on to the financial matters. The first part of financial matter is impact of COVID-19 on financial and finance. And the second portion is how to use the opportunity. In other words, responsibility of the financial sector. So let's start the first part, what happened now. So the COVID-19 economic growth rate is going down. So for instance, early March, some institute OECD said 2% growth, but now after June, many institutes show negative growth, like a -6% or 8%. So gradually, the economic forecast was worsening. But the point is uncertainty of the recovery from the infection. Like China or Korea, already peak seemed to be over, but still India or Brazil, number of infected people are increasing. Next, please. So this is a case of Japan. The number of affected people are described here. The red is number of the infected people. It's growing but down, but the problem is now becoming increasing. So many people are afraid of a second wave. So as I mentioned, uncertainty is clear. So next one, please. So the impact on the economy in Japan. So the one important thing is local economy. In general, local economy in Japan is very weak, and that is a critical agenda for the future of Japan. But the impact of COVID-19 on the local economy, of course, the impact magnitude and the type of the impact differ region to region. But you can see the middle, Tohok and Chugok. It's a not a central area. At their employment number of bankrupts is much higher than the Japanese average. So of course the COVID-19 impact is very serious, but uneven to the local economy. So the very serious situation, I understand. Next, please. So how to take countermeasures by a government. You can see the government provided the emergency support program. Total amount is 120 trillion Japanese yen as a first and the second supplementary budget. And the total impacted activity would be more than 200 trillion Japanese yen. So the breakdown of the second government program is number 2, major expenditure. You can see most of the element by the government is emergency support, like working capital support for corporate, employment support, and the rent support to individual on the corporate and others. So this big amount of expenditure are how to fund it. It's a government bond. So around 19 trillion Japanese equivalent to government bond is going to be issued. So the Japanese annual budget is 100 trillion Japanese yen. So the very big size, and also the total outstanding of government bond is going to be over 1,000 trillion Japanese yen. Very big. That means more than around 2 times of GDP. So this is an important impact on the Japanese economy. Next one, please. So back to the climate change and the global one, energy and emission. What's happened now? So demand for energy decreased. It is quite simple because economic activity is down. So the IEA expected in 2020, compared to the 2019, demand for energy would be down to 6%. So also they analyze the impact on emission, carbon dioxide emission, 8% down from previous year. So you can see the right side lower part chart, CO2 emission, historical emission. So this is the highest, biggest negative impact on history. So this is a bigger impact than a so-called Lehman shock. Next one, please. So from now on, I would like to touch upon the impact on the financial sector. So our important lesson from COVID-19 is a risk of supply chain. So for financial people, so this is important lesson and need to reflect on due diligence on financing. So this is a typical risk control table: political risk, commercial risk, technology risk, and also financial market risk. So many things need to be carefully reviewed. But after the COVID-19, we have to add some more element for due diligence. For instance, the political risk, the lockdown risk. This is a politically decided lockdown risk is there. And also the one important and the very carefully think about is protectionism. It's a rather long term. So many countries are aware the supply chain risk, and they seeking and they put high priority on domestic supply. If too much rely on the domestic, so that would provide a negative impact on the trade. So trade restriction, such kind of risk is need to be carefully reviewed after COVID-19 or the due diligence of finance. Commercial risk, it is important for the supply chain risk is very important, upstream and downstream. So the long supply chain, so the if we provide a financing to the some project, we have to take care about the upstream and the downstream of the project. If the at the long the supply chain, one part would be collapsed, the all operation need to be stopped. So the supply chain risk need to be carefully reviewed. And also the another issue is sponsor risk. So I think for instance, case of aviation sector, one of the seriously affected sector is aviation. So the almost zero flight in May or April. There are so many airlines, but sooner or later, after the finish of the COVID-19, passenger and cargo will be back. So how to endure the time for the recovery, that is important. If without sufficient supply of working capital, the sponsor will be collapsed. So the financial risk of the sponsor, that is a risk. But in the case of Japan, so far, not so serious, because one of the reasons why is Bank of Japan provided the plenty of liquidity. So the financial market is still so far fine. So this is not emerges yet. So the next one is the financial risk. So the financial market distortion, we have to take care, and also the other self-defense measures. So that we have to pay attention on whether enough cash position the project and the company has. So like a conventional financing, the project finance case, 3 to 6 months cash reserve is necessary for the contingency, and the normal corporate finance, the 3 months cash is necessary for the contingency. Such kind of the conservative way is need to be considered again. Of course, the role of leverage finance still important, but all the financial people seek for and go for the leverage finance. Financial market will be collapsed. This is a system risk. So we have to take care and carefully think about the kind of the moral of the financial people to the and that is a responsibility to the industry. Next one, please. Yes. So one interesting lesson from COVID-19, as I mentioned, the supply chain risk. So we find some similarity of the risk with climate change and COVID-19. Of course, the COVID-19 or pandemic, the risk will be appeared mostly in the people, and the climate change provides the risk on the physical structure and equipment. That is the difference. But the common thing is measures, countermeasures. So the more conservative way of lending. So the balance of the leverage finance and traditional finance is needed. So if, for instance, if the company with a very rich cash position, so recently such kind of company are criticized by the financial investors. You need to use the money more efficiently. But this kind of extraordinary situation, cash is important for survive this kind of crisis. So the rebalance of the efficiency and the resilience, that would be an important lesson from COVID-19 for the financial people. Next one, please. So the next one is opportunity. So the green stimulus is discussed many areas. Typical one is EU. They propose next generation and under the consideration. So green is important because after COVID-19, we have to think about the recovery and also growth strategy. So as previous speakers already mentioned, the big amount of money are spent by the government. So that is the burden for the future generation. So how to reduce it, how to minimize additional burden for future generation. One of the way is the economic stimulus for solving the threat on the future. One typical threat is climate change. So my proposal, and maybe other people also same way of thinking, 3-step approach. First one is emergency plan, like Japan, support of working capital and support of unemployment people. It's an emergency plan. It is definitely needed. But second step is economic recovery, and maybe after that, growth strategy. How to combine green element on recovery and growth strategy. Some example I explain here. The right side column is a retrofit energy efficiency, renewable digitalization. So what kind of area are suitable for the area to be green? Next one, please. So my idea is 4 elements need to be highly prioritized: employment and multiple economy effect, and the quick impact, and the climate change, and the long-term growth, and the local economy support. So the many different investments are there, but there's a different one by one. Like for instance, renewable is a climate change. That is good, but increase employment or not, it is a question. For instance, lower part is a figure from IEA. A renewable project in general provide a big amount of the increase of the employment, but the investment side and the manufacturing side are different. So we need to carefully think about who would be a beneficiary of the increase of employment. And one quick and one of my recommended area is retrofit one, because very quick and locally benefit will be provided to local. Next one, please. So here the 2 example of the innovation financing. So the incentive through the local bank. As I mentioned, the local economy is seriously affected, and how to support the local economy under the climate change. So this structure is through the incentive, through the bank incentive we deliver to the investors. So this structure are implemented in Japan, but unfortunately it was suspended because the sharing of benefit by bank and the investor has not been determined, and the impact on the local economy is small. But if it goes well, the triple benefit are expected: local economy support, reactivation of the banking sector, and also climate change. So the first provided and delivers the incentive and the fixed rate, but there's a further development possible. So if this structure would be changed to transformed to the auction system, the incentive amount would be changed to the variable level, similar to the carbon market. And number three, third step, emission trading this structure can be transferred to emission trading scheme. Next one, please. So the another important thing is for the climate change is how to encourage the early stage technology. So this kind of area is not familiar with, not good at the bond or financial market, but the PPP model could be possible. So this is a case of CCS. So CCS is an inevitable technology for long term, but the conventional governmental support is a door-to-door basis. So the CCS value chain is a capture, transportation, and sequestration, 3 steps there. But the typical one is provide an incentive or subsidy to the whole project, the capture, transport, sequestration, 4. But now situation is changing. So the PPP model is possible. Capture would be implemented by private, and the transport and the sequestration should be implemented by government as a public infrastructure. And also the transportation can be transformed to the BOT is a PPP project. So this is a kind of innovation, and the bond can be applied to this structure. It's a project bond. In the case of the local project supply, I think these type of projects are not good at the bond because the due diligence of the local project is not good for bond, but how to combine with a local bank, that is one of the options to solve that problem. The last one, please. So this is a conclusion. So as I mentioned, for the after the and under the COVID-19 impact on the financial sector, it's a supply chain risk. How to deal with supply chain risk, and the opportunity and the contribution. So of course that is opportunity, but this is an important contribution for financial sector. How to collaborate with a project, and also how to overcome the bottleneck of government funding, lack of government funding. Thank you very much.
Thank you very much, Mr. Hongo, for your informative presentation. So it was very interesting, especially the risk control checklist that you presented. That was very interesting to me. So our next distinguished speaker is Mr. Cedric Rimaud. Mr. Cedric Rimaud is from the Climate Bond Initiative. He is the ASEAN Program Manager at Climate Bond Initiative. Cedric has more than 20 years experience in the fund management industry, and with more than 10 years at top-ranking investment banking firms including JP Morgan, Citi, and Credit Suisse. In addition to that, he has done projects in this field for international organizations, including the United Nations, ESCAP, and it is a great pleasure for having Cedric today. So just a moment, let me share the screen. Cedric, please.
Thank you very much. Good morning, everyone. Thank you so much for having me today. It's a pleasure to be here. Climate Bonds Initiative is a not-for-profit organization based in the UK and acting for the green bond market by providing guidance on how to select projects that are aligned with the objectives of the Paris Agreement, which in 2015 was signed by all nations around the world to limit global warming well below 2 degrees against pre-industrial levels. I'm going to start this presentation on the next slide, please, by a survey that has been conducted by international marketing firm Ipsos. They asked people around the world how the response to COVID-19 by governments, how the stimulus packages should address specific sectors in the economy. Can we see the next slide, please? So you will see from the slide as soon as it's shown that people around the world are relatively balanced. There are three categories. There is a category of people who think that the response to COVID-19 should be to all sectors and businesses that are in need in the economy, irrespective of their carbon emissions. And there is a category of people who think that this response should be directed at all sectors and business in need if they have demonstrated measures to significantly reduce their carbon emissions and their impact on the environment. And then there is a third category of people who don't really know. What is striking from this study is that if you look at the bottom of this ranking, you see all the countries of the developed world: United States, Canada, Sweden, Great Britain, Australia, Italy, Germany, Belgium. And in this category, people are actually more inclined to see the response to COVID-19 to sectors that are not green. Whereas at the top of this ranking, you see younger countries that are developing and with populations that are growing very strong, like China, Malaysia, Mexico, India, Peru, Turkey, Chile, and so on. In this category, there is an overwhelming majority of people who are looking at the response by their government to COVID-19 to sectors that are indeed low carbon emissions. And that's very interesting because traditionally we hear that the response to climate change is coming from Europe or developed market. But actually, people who care are also in emerging economies. And yet, when we look at the Green Stimulus Index, as it has been published by Vivid Economics, on how the response to COVID-19 has been aligned with green objectives, we see that it's only a few countries in Europe that are resolutely embarked on a response that is green. And a lot of the packages that have been implemented, including in the developing world, is actually not green at all. It has a negative contribution on the environment. So that's one thought I wanted to share with you, first of all. The second thought I wanted to share with you is the situation in the financial markets. We have yields globally that have reached all-time lows. If you look at 10-year JGBs, as you know, they have reached extremely low levels. In Europe, we have this situation where we have negative 10-year bonds yields for some time already. And if we look at the distribution of global bonds, which is a massive market, as you know, the proportion of bonds that are yielding a return in excess of 5% is only 4% of total bonds outstanding. There is a very vast majority of bonds that are yielding between 0 and 3% yield, and a non-negligible portion of bonds that are yielding negative yields. So that's not good for investors, and that's a concern for long-term savers. So that's the second thought I wanted to share with you. Now let's look at green bonds. Green bonds globally are attracting a huge amount of interest. 2019 has seen the emission of more than $250 billion of green bonds globally, with Europe and Asia Pacific the two largest regions. And this is a very important growth on 2018. Globally, at the end of June 2020, there were $863 billion of green bonds outstanding. We are on track this year to reach 1% of the total bond market being made of green bonds. Now, you may think that 1% is a small number, but this has been achieved in less than 5 years. So this is a tremendous growth and a tremendous momentum that is behind this emergence of green bonds as a separate asset class. It is already bigger than the global convertible bond market, which has existed for decades. And we expect this growth to continue. This year, the issuance is a bit slowing down because of the COVID-19 response, but there are some other thematic bonds that are being issued in the market. What we see, for example, with pandemic bonds or sustainability bond or other social bonds that are providing an offset and that are also in align with positive ESG objectives for investors. If we look at the world map where these green bonds are being issued, there are a few very big markets that are leading the way, including in the US, contrary to popular belief that the US is not doing much for climate change, but because of obviously the development of their bond market that is very liquid and very active. And there are some very big issuers there, including, for example, Fannie Mae for green buildings, the New York Metro, California, and so on. China is another big issuer with a very recent development where the Chinese regulators have harmonized their definition on green bonds to make it more consistent across different categories within their markets. In Europe, we have several countries that are also leading the way, including France or Sweden, as it has been demonstrated before. But what is very noteworthy is that the emerging markets are lagging behind. And we saw that there is strong interest from the populations in emerging economies that the response of their government is green. And this is a big opportunity for governments, local governments, state-owned enterprises in developing economies to seize this opportunity to raise fresh capital through the issuance of green bonds. And there is a lot of infrastructure that needs to be built in these economies to respond to the growth of their population, to the development of their cities with problems of transportation and air pollution and others. So bonds are a very easy tool, financial instrument to use to finance those projects and use the future value that will be created through those projects to finance today's investments. So this is a very, very important opportunity for creating new sources of financing for those economies. But let's focus on this green bond market. So globally, the use of proceeds, which is what defines what is a green bond, so how the capital is allocated, this use of proceeds is mostly going to, first of all, the energy sector, naturally because there's a lot of renewable energy projects that are being financed through green bonds. The second category is green buildings, which buildings are a very large contributor to greenhouse gas emissions globally. So transforming them to a low energy consumption and aligning their standards with global building standards that are indeed green is a way for real estate developers to get financing through green bonds. The third one is transport. Low carbon transport is a big part of the investment that is being realized. For example, we have a very significant transaction in Thailand with the BTS group, which runs the SkyTrain in Bangkok, which did a very successful green bond and attracted 8 times as much demand as there was bonds on offer through their recent green bonds. And this was offered in local currency in Thai baht. So that's a demonstration of how transport projects in in Southeast Asia, for example, can attract such capital. And then we have other sectors like water management, waste management, and land use, and others. If we look at the types of issuers that are coming to market with green bonds, there are 2 leading types, which are the non-financial corporates and the financial corporates, which are basically making the bulk of the non-government issuance. But on the government side, we have three categories. We have government-backed entities, we have local governments, and we have sovereign issuers, which combine exceed those two first sectors. And the other important sector is the development bank sector. There is a lot of green bonds that are issued by the likes of IFC, ADB, and others as well. And then there is an emerging category, which is the asset-backed securities category, which also starts to see more and more issuance of green bonds through the refinancing of assets that are green. Now, Climate Bonds Initiative has conducted a recent survey of European investors representing several trillion of assets under management for fixed income. And our interest was to ask them what kind of green bonds would they like to invest in. So on the left-hand side, you can see the current distribution of the green bond market. It's mostly driven by development banks, in terms of outstanding, that is. Development banks, financial corporates, non-financial corporates. But actually, investors would like to see more non-financial corporates issuing green bonds. They want to see financial corporates as well. And they want to see more sovereign issuers also. And that's a good development because it's encouraging governments around the world, including in developing economies, to come to market with sovereign issues that are green and that can finance resilient infrastructure in response to the current crisis or to the longer term crisis that is climate change. And in terms of the categories that investors are interested in, it's actually quite widespread. They are interested in energy, in transportation, in buildings, in water projects, in waste management projects, in land use and others. So in order for investors to really feel comfortable with this market, there is a very important component, which is trust and transparency. So the green bond market has really started to emerge when the International Capital Markets Association in 2014 published the Green Bond Principles that laid the foundation for the definition of green bonds. So the process for issuing a green bond starts with the issuer starting to identify the assets that meet the relevant criteria of the standards and create what we call a green bond framework that sets out how the proceeds of the bond will be used under the issuer's internal controls. The second step is to hire what we call a verifier, which is an independent assurance provider who would come in and review how the issuer has set their green bond framework. So the issuer will provide them with the relevant information, and the verifier will provide the issuer with what we call a second-party opinion report, which the issuer can use to assess to investors that indeed the projects that are selected are green. At this stage, there is an optional third step, which is to come to Climate Bonds Initiative and receive a certification under the Climate Bond Standard, which is a standard that we have developed, which is internationally recognized, that sets, based on scientific evidence, what type of projects are aligned with the Paris Agreement. This certification is delivered at a very, very small cost, about $1,000 only, for the issuers to go out to investors and tell them, look, I have received the certification from Climate Bonds Initiatives, the projects I am financing are indeed aligned with the Paris Agreement. After the bond is issued, there is a fourth step, which is the post-issuance reporting. So the verifier and Climate Bonds Initiative, if we have provided a certification, within 24 months of issuance, will receive the information from the issuer and provide a confirmation that indeed the green bonds has been properly allocated. And then finally, there's a more ongoing process, which is the fifth step, which is to report annually on how the green bond have been allocated. I want to say that our certification and the green bond principles are based on 100% allocation to the green projects. There is no discussion about 60%, 80%, or so on. It's 100% of the proceeds must be allocated to the green projects that satisfy the criteria. So Our climate bond standard is based on what we call a taxonomy for green transition, which is based on scientific input by experts in their field that have been assembled and that have told us what type of projects are aligned with the objectives of the Paris Agreement. And where you see a blue dot, that means that we have already designed a criteria that issuers can use to select their projects. So in the energy sector, in the transport sector, in the water sector, in the building sector, and so on, in the waste management sector, it is possible for an issuer to receive confirmation by an external party that their projects are indeed aligned with the Paris Agreement. This is a very strong testament of the greenness of their projects. And this is true. The market initially suffered from a little bit of a diversity of standards. You had China with the green catalog, you had ICMA with the green bond principles, you had the EU, which is developing its own taxonomy, and so on. But at the same time, the bond market is accustomed to this. If you are told it's an investment grade rating, do you mean it's an investment grade rating from Fitch, from Moody's, or from S&P? They have different methodologies as well, yet the market knows that an investment grade rating is an investment grade rating. So there's a little bit of that going on in the green bond market as well. There's a few main standards that exist, but at the same time, there is a trend for those standards to converge. For example, China has harmonized the various definitions that it had across its regulators. The EU is looking to develop the climate bond standard, and Climate Bonds Initiative, our CEO is actually part of the expert group that is working for the EU on that topic. Climate Bonds Initiative will make sure that the taxonomy we have developed also complies with the EU definitions. So there is an ongoing work that is being undertaken to ensure that this is happening. So I would like to conclude by saying that the green bond is a very important response tool for governments across the world to COVID-19. And I would also add that social or sustainability bonds are also very great tools because they define very narrowly what the use of proceeds will be for the capital that is being raised. And that's comforting for investors. And what is important for investors is to know what they invest into. More and more investors globally have specific mandates to respond to ESG criteria. And these standards that are being developed are giving them the guidance they need to do these allocations. And I would like to say that in terms of the optimal portfolio that investors are seeking, an important aspect to note is that climate change is a future risk. It's not embedded in historical numbers. It's a risk that is increasing and becoming more and more prevalent. So if we based our optimal portfolio on historical volatility numbers, we may get the wrong picture because the volatility of the past is not the same as the future volatility because of climate change. There is an increasing occurrence of extreme weather events. There is increasing flooding, increasing hurricanes or high winds or droughts and so on. And this is causing the volatility, the assumptions that we have in our model to become misleading. And by incorporating green securities in our portfolio, like green bonds, we are basically responding to this new bucket of risk that is climate change, how it affects the valuation of our securities, of our investments. And that's an important aspect of risk management that this taxonomy and these standards are here to respond to. So my last slide is basically to give you a message of hope, because green bonds and other social or sustainability bonds are very interesting instruments to access the trillions of capital that is available for investment that is currently earning negative or very low yields, and provide investors with new investment opportunities in the developing world that is yielding higher rates of return and that is providing a better risk profile in response to climate change. If any of you are looking to do any studies on this topic, Climate Bonds Initiative has data that is available for researchers. So my contact details are on this slide. Please come to us. We can provide data on the green bond market. And this is a vast area of research that is very developing pretty fast. And we are seeing very good papers already on the valuation of green bonds or on their typology and so on. And please, I really encourage you to come forward with this. Thank you very much for the opportunity. And I remain at your disposal for any questions.
Okay. Thank you very much, Cedric, for the interesting, informative, insightful presentation on green bonds. So we will have all presentations, and after all, we will have the Q&A sessions. I'm sure that there are several questions. So our next distinguished speaker is Dr. Ho-Seo Kim from Korea Environment Institute. Dr. Kim is the Director General of Sustainability Strategy Research Group at Korea Environment Institute. Dr. Kim was a senior advisor to United Nations Institute for Training and Research, UNITAR, on green economy and SDG, and also served as principal economist and head of green growth modeling at Global Green Growth Institute, GGGI. In addition to that, he also served as a research professor of sustainable development at Yonsei University. Dr. Kim, please.
Thank you, Professor Farhad. I'm Ho-Seo Kim, the Director General of Sustainability Strategy Research Group of the KI. So it's a great pleasure to join this webinar, which is very timely and important. Thank you for inviting me. So unfortunately, I didn't prepare slides. My apologies. Please let me share my ideas with you briefly this time. I think that I'm the fourth speaker in the middle of the speaker list, so I hope you take it as a small idea break thing. So at KI, we are also working on several dimensions of the COVID-19 recovery plans at the national and global levels, mostly from spending side. But as this webinar suggests, I think we need to address the finance issue at the same time, which is on the other side of the coin. So the idea I'd like to share with you today is about how to link two challenges, spending and financing, particularly focusing on the green stimulus case. So as the several speakers mentioned, the world is experiencing unprecedented economic challenges from the COVID-19 pandemic, and many countries have been introducing large-scale fiscal packages to combat the recession. And U.S. adopted the largest federal stimulus package in history in March. And as you may know, last week, EU leaders reached a deal on a 1.8 trillion euro COVID-19 recovery fund. Here is one of the interesting things about countries' recovery plans introduced in the COVID-19 recession is that to some extent, and at least, they are guided by so-called greening the recovery principle. From the pretty much earlier stage of the crisis, its importance has been emphasized by many international organizations, including UN, IMF, and OECD. UN is calling on governments to seize the opportunity to build back better by creating more sustainable societies in the process of planning for a recovery plan. And IMF calls for policymakers to focus on boosting climate smart infrastructure such as the renewable energy and modernizing the electricity grid and public transport. And OECD Secretary General said that we must ensure the post-COVID recovery integrates climate and biodiversity concerns. So Korea is also following this direction, and recently we have placed green stimulus as one of the two pillars of the Korean New Deal plan, which is part of our recovery plan focusing on comparativeness led by digital technologies and the sustainability of our economy in the post-COVID-19 world. So one question here I have been trying to figure out this day is, what does the greening the recovery principle mean for financing the stimulus package? What would be the implications of Green Deal for financing the recovery plan? I think that to answer this question, I thought that we need to identify what would be the economic benefits of a Green New Deal first, because that would give us a good guide on how to finance the project proposed by the Green Recovery Plan. Last month, I published a short paper on the economics of Green New Deals. Unfortunately, written in Korean. I'm sorry about that. In the paper, I defined 3 different types of economic benefits based on their sources that can be gained from a Green New Deal style recovery plan, including stimulus benefits and cost-effective benefits and green benefits. Stimulus benefits arise from increased economic activities and jobs. So Green New Deal is environmental and fiscal policy, as you know, which consists of a set of projects for boosting the economy and enhancing environmental sustainability. And the stimulus benefits are one of the primary goals of all stimulus packages. Secondly, cost-effective benefits are expected from all New Deal style project implementation, which is characterized by spending a large amount of capital for a specific purpose within a relatively short period of time. In this case, governments can achieve economies of scale by lowering the average cost of individual projects. For instance, we can build 100 wind turbines at a much lower average cost than a single wind turbine project. And we can, we also can enhance the cost effectiveness further by combining relevant projects that can reduce the entire system cost. For instance, a renewable project combined with a grid refurbishment project or an energy storage system can enhance the overall cost effectiveness further. And green benefits are the primary goal of this green stimulus package. All Green New Deal projects are environmental projects, and they reduce environmental externalities or increase ecosystem services. It's unlike the stimulus and cost-effective benefits. Green benefits can be very diverse in terms of spatial and temporal scope, which can make the finance planning complicated. So considering a relevant share of a current Green Deal project in many countries, they are aiming to tackle the climate change, climate challenges. So I think we can say that we are focusing on, in terms of green benefits, we are focusing on long-term and global scale green benefits in the context of COVID-19 green stimulus. These 3 types of economic benefits give us interesting implication on financing the green stimulus. First, we can, regarding stimulus benefits, we can increase stimulus benefits simply by reallocating financial resources across different phase of a business cycle, from expansion to recession. And regarding cost-effective benefits, we can increase cost-effective benefits simply by reallocating financial resources across different sectors of the economy, from industry to green, or from agriculture to health, something like that. And regarding green benefits, we need to allocate financial resources across the generations, between current and future generations. In this case, I think that this gives us two implications for financing. One is sovereign bonds are a good way to finance green stimulus packaging. Time horizon of cost and benefits are similar, and sharing the cost of sustainable development, which is the goal of the Green New Deal packages. Sharing the cost with future generation is reasonable, and based on that, we can invest more for the future generation, for more Green New Deal project. The other point is that the green finance is essential in the COVID-19 economy. So otherwise, great investments in the expansion period would jeopardize all the green benefits we get from the green stimulus packages we are considering. So yeah, that's the idea. This is the idea I want to share with today. Then thanks again for inviting me, and I try to combine the spending side and finance side of green stimulus packages, and I hope that it was interesting to all. Thank you very much.
Thank you very much, Dr. Hosoki, for your presentation. So the next presentation is by Professor Hyun-Suk. So Professor Hyun-Suk is currently the Dean. Just a moment. He's the Dean of East Asia International College and Asia Research Center at Yonsei University. Before joining EIC in 2018, he was the visiting scholar at University of Southern California and research fellow at Korea Capital Market Institute. And before that, he also spent 3 years in Japan as a bond market specialist at the Asia Bond Market Initiative Task Force at Japan Bank for International Cooperation. So it's a pleasure to have Professor Hyun-Suk today. And Professor Hyun-Suk, floor is yours. So let me share the screen.
Thank you very much for your kind introduction. And please share my slide. Okay, thank you. And let me start my presentation on building resilience amid COVID-19 through capital market. Yeah, please, next slide.
So just a moment, please. Just a moment.
Okay.
Yes.
Okay, yeah. First of all, I briefly touch upon the background and the issue raising for my presentation. And second part, I talk about the COVID-19 response and the capital market, especially the importance of a role of the capital market in the responding the COVID-19 crisis. And then lastly, let me conclude my presentation and provide some implications. And next. As you know, the unprecedented shock by COVID-19 pandemic has brought the fundamental change to our economic and society. In response to this pandemic, the many countries already fighting the invisible virus with unconventional monetary and fiscal policies. And fortunately, the COVID-19 triggered lockdown has temporarily reduced greenhouse gas emission with the factories and the business closed and the road empties, as already the Professor Matsushita mentioned. So as a result, we can enjoy clear blue skies and good quality of air recently. These effects have been so large that total CO2 emission in 2020 will be about 4 to 7% lower than estimated before the crisis. This fact is already explained by the Professor Matsushita. However, this change will depend on the duration and extent of a global lockdown, and time will take to resume our normal activities. The temporary drop in carbon emission from the global lockdown will not solve climate change problems. So because the economies are likely to rebound with burning more the fossil fuels as before after COVID-19 is finally curbed in. The next slide, please. The current crisis gives valuable lessons that decisive preemptive action is crucial in tackling global disruptions like global pandemic and also the global warming. As a safeguard from global disruptions, global pandemic require us to put our economies on hold and to enforce lockdowns, but global warming requires us to transit toward the sustainabilities. So we can easily imagine we could face a more catastrophic consequences if we neglect or delay our efforts to fight climate change. And while the pandemic can eventually and hopefully be reigned, global warming is much harder to reverse with a higher cost of taking no action today. Therefore, the abundant liquidity from the massive stimulus package for the COVID-19, the recoveries should be channeled into productive areas for economic recovery and sustainable growth, while we attempting to avoid the risk of increasing debt and the climate change becoming a long-lasting burden for the future generations. Now, from this perspective, the COVID-19 will be a good opportunity to consider the climate change and to mitigate climate change, because the crisis will require great reallocation of resources like capital and labor across the industries and economies. I think it's already happening. In other words, it is very important to raise growth potential today and to accelerate the transition toward a low carbon economy on more sustainable growth path using strategic investment programs and the capital market. The COVID-19 pandemic could give a unique boost to green capital market and help reduce the cost of transitioning toward low carbon economies. It can facilitate a diffusion of a new and green technology that improve productivity growth and the sustainabilities. Next, please. And next, please. So if you look at these tables, already many MDBs like International Financing Corporation, African Development Bank, and the European Investment Bank, other government, they issued so-called COVID-19 bond or COVID-19 response bonds under the category of social bond or sustainability bond. So yeah, I do not explain one by one, but if you look at this table, there are many cases, but we don't have any clear-cut definition for COVID-19 bonds. They just issued the general bond to fund the COVID-19 relief measures. And next slide, please. And yeah, if you look at these figures, you can see the trend, the green, social, and sustainability bond issuance in 2018 and 2019 and the 2020s. Just to compare the green bond, the GSS bonds in 2018 and 2019, you can see the upward trend. Green bond increased and the social bond and sustainability bond increased. But however, if you compare the 2019 and 2020s, the green bond decreased because of a negative impact from the COVID-19 crisis. But so when we designed the recovery package and the policies, we should also consider the risk of climate change, and that recovery package should include those the negative impact. And please, and next slide. So yeah, more social sustainability bonds are being issued to finance projects that can mitigate the socio-economic consequences of pandemic in the context of a COVID-19 crisis. And as I already explained, that the many MDBs, and they issued these categories of bonds. And next slide, please. And there are so many different types of bonds dealing with the climate issues or social issues. Sometimes some bonds, they deal with the broad scope of the sustainabilities. So I summarized 4 different types of bonds. Let me explain first the green bonds. Green bond finance new and existing project with environmental the benefits, for example, renewable energy project or electric cars. And ICMA, they already set up the green bond principles. So that principles include the 4 core elements: use of proceeds and process for project evaluation, selection, and management of proceeds and reporting. And also social bond finance new and existing project with social benefits. Also ICMA published the social bond principles. These 4 elements are the core factors for both the green bond principle and the social bond principle. And we have another the category of bonds, the sustainability bonds, aligned with the 4 core components of both the GBP and SPB. It's a kind of the mixture of the green bond and the social bonds. And also the ICMA, they published the sustainability bond guideline. Lastly, we have another category of bond is the sustainability linked bonds, defined as any type of bond instruments for which financial and or structural characteristics can vary depending on whether the issuer achieves the predefined sustainability and ESG objective. So I think that the last bond have the broadest scope compared to other green bond or social bond and sustainability bonds. As Professor Yoshino already mentioned, we don't have a clear cut or the common definition of in this field. So that's the major the barriers to further develop this kind of the bond market and capital market. Next slide, please. And also there are some the major difference between the green social sustainability bonds and the sustainability linked bonds. So the major difference is the sustainability linked bonds are intended to be used for general purposes, while the green and social and sustainable bonds, their proceeds are earmarked for green project or social project. So the process for the calibration one or more the SPTs, the sustainability performance target per key performance index is key to the structuring of sustainability linked bonds. So this focuses the attention of investors and the market on the overall sustainability performance of the issuers and not each project and assets. There are these are the major difference between the green social sustainability bond and the sustainability linked bonds. And next slide, please. And also, we, if you look at this diagram, this is taken from the ICMA the report. So this diagram shows the terms used in the sustainable finance field, such as climate finance, impact finance, and green finance, and social finance. As I already mentioned, we don't have the clear-cut differences or clear-cut or the common definition of green finance, climate finance, impact finance, social finance, and sometimes some financing method include environment and social and the governance, ESG investment. So if you look at the figures, the sustainable finance is the widest definition, include green finance and the climate finance and the social finance and the ESG investing. And the definition of impact finance interact with green finance and the social finance, as you see from this slide. And next one, please. That's why we have suffering from lack of common definitions and very different ranges and taxonomies. So without clear-cut definition and the common taxonomies, we can also we cannot price the environmental risk because it is very difficult to quantify the climate risk and also some externalities generated from the environmental project. And also the lack of market depth and liquidities, the investors are reluctant to invest into this kind of the financial products. And also the risk return profile is not attractive to investors compared to other the general products. And next, please. Let me conclude and provide some implications for my presentations. So as we learned from the COVID-19 pandemic, the combination of a monetary and the fiscal policy is most effective when they complement each other's. I think that this will also be applicable to fight against the climate change, which make our economy more resilient and sustainable. And therefore, we should design COVID-19 recovery package and policies to meet both economic and climate goals so that they enable the economy to reallocate efficiently resources toward more productive areas for the future generations. For market to support the green economies and to secure the financial stabilities, asset prices need to correctly reflect the externalities associated with the climate change. So in order to internalize these externalities, so Yoshino Sensei estimated the spillover effect generated from the infrastructure projects as a source of a payment of principals interest by using DID method. So it can make the green financial product more attractive to investors. However, at the current stage, the capital market are suffering from various market failures, especially the uncertainty about what qualifies as green is one of them. And also, as I already explained, the the common definition and standard are the fundamental building block for pricing environmental risk. So therefore, clear definition should be built on the current market practice and existing terminology to address the need for convergence among market players and the various stakeholders, especially in the sustainable financial market. And the climate-related information should be more disclosed and more standardized. That's all my presentation. Thank you for your listening.
Thank you very much, Professor Hyun-suk, for the interesting presentation that you had. So our next distinguished speaker is Dr. William Kim. Dr. William Kim is working at the Bank of Communication in Korea, Republic of Korea. He designs and introduces Korean won and Chinese yuan home currency transaction for Korean financial institutions. He worked at the investment banking department for 13 years and foreign currency trade department for 5 years in previous Woori Bank. So it is a pleasure to have Dr. William Kim, please. Let me share the screen. Yes, please, Dr. Kim. Dr. Kim, your mic is mute. Would you please unmute your mic in the left? Yes.
All right. Can you hear now?
Yes.
All right. Yeah. Sorry for that. Thank you for the giving me a chance to present this issue. I'm starting from the investor's view because the green project need a private sector participant. So the private participants' view is important to further extend the green market. So I will summarize the current market circumstance based on several articles from the Financial Times. Next, please.
Just a moment. Just a moment, please. Yes.
My presentation has 3 parts. In first part, I will review several Financial Times articles on the green and climate issue. These articles raise several issues in the green market. And in second part, I will review briefly about the green bond market and in terms of the conventional capital market conditions, and also compare those to the market difference. In part 3, I will summarize the findings of part 1 and 2 and provide small suggestions. Next, please. Let me show the conclusion at first. We need a team play, and also we need the set play, and also we need a rule play. First of the financial article on the climate issue, the first page is the good news. The S&P 500 ESG index beat the general S&P index by 0.6%. And MSCI emerging market ESG index also outperformed by 0.5% recently. And the global fund manager BlackRock, they explain this case as the investors more buy too, so the price rise. And second is the better supply chain management and the corporate governance of the ESG companies. So this point, the second point is some reason for the sustainability of the green bond in the market in the future. I mean, to get the high ESG rating, they must comply with the sustainability accounting standard rules. So in the long term, these green companies start outperform compared to the general market index. So the high-rated the ESG company, they outperform the market. Next, please. In July, the Japan announced new financing policy. They cut financing for coral power station in Southeast Asia, and this helped shift to the greener energy. In principle, it was self-forward, but the outright ban should have been adopted either. But unfortunately, there was no outright ban on the coral power. In July, BlackRock, which managing 6.8 trillion, the fund, had placed 244 companies on watch for the insufficient process of climate issue. It also planned to exercise voting right on the 53 company this year, and also the remaining the rest of the company by next year. BlackRock actually was criticized by the investor for failing climate change resolution in line with the Paris Agreement, and the investor raised this issue to BlackRock. So the BlackRock has no option but to follow the investor's instruction. Next page, please. Okay, let's look at the shipping side. Shipping accounts to 14% of all the global emission of sulfur. In March 2019, International Maritime Organization, which is the UN body, announced to slash the sulfur contents of the shipping fuel from 3.5% to 0.5%. It applied to all the global shipping industry. But the US want to block through the new environmental rule in the shipping world. But later, USA find out that the US energy industry has dominated the low sulfur market, which means the US already invested more than $100 billion. So they have some comparative advantage. So they may not object to shipping side some policy in the future. And also the Europe side, Western politicians on the green agenda, they have not talked about this kind of issue anymore because they have disadvantage compared to the US energy sector. So through this case, we can see that the green is not the only the commercial issue, but heavily the regulation issue and also some competition issue and also some the political issue either. There is the interesting article on the Australia. One investor who buy the Australian government bond, he sued the Australian government because the Australian government does not fully disclose the climate risk potential on the bank under the bond the information memorandum. So currently the market view is that Australian government may be breach some potential of disclosing law of the information. So through these two cases, we can see the investor may take some action, and then that helps some climate change investor in the future in the commercial market side. Next slide, please. Let's look at the fund manager side either. In case of the pandemic bond, only less than 1% are invested in green recovery at the moment. And the review of the 75 largest fund globally, they show that the all funds did not exclude coral industry investment yet, unfortunately. And the 39% of fund does not mention anything about the climate issue. In US, only 16 of the 74 largest public pension, they mention the ESG issue. So the remaining others never mention about this issue. Even though we realize that the financial risk of climate, like the COVID-19, is more important than the interest rate or FX exchange rate risk, but the only measurable value and the risk are based on the investment process. Excuse me. And the CFA study in 2018, November, they have a survey on this issue. And the survey result is that even though 85% believe to take ESG, including the climate factor, to the decision-making process, but they frankly speak out the fiduciary duty conflict with the ESG, the investment. So they are incomplete in between by law from the investor side, and also some the recommendation of the climate side. So it indicates that our profession and investment world rely heavily on too much the historical data, because the investment process, as you know, where it's all based on data and some the methodology or concept. So the still comparing to conventional investment banking process, the climate the bond has some long way to further forward. Next slide, please. February 2020, this year, showed that the green issue is not the green issue only, but the political issue also. US has withdrawn from the Paris Agreement and threatened retaliation if EU introduce its one carbon border tax in Parliament. In EU side, also not good, which means UN Climate Summit, which say COP26 is to ensure that every financial decision must take the climate change into account. But only 5 out of the 26 largest banks in EU partially disclose climate risk, and none of the 26 European banks disclose, not full disclose the climate issue yet. So even though they fully agree on the climate issue, there are still some political issue in the market. Next slide, please. UN government panel on the climate change, they warned the EU bank about the Paris Agreement breach. EU plan to coral-free by 2030, but EU bank keep rolling EU coral industry loan, the financing. In Japan also, just 1 month ago, Mizo Financial Group rejected climate-related proposal. Mizo is one of the big 3 Japan bank, but they were previously supposed to be more transparent on the climate issue. But and actually climate proposals are submitted, they rejected with some other reasons. On the other side, in US the Security Commission, they call for better ESG labeling, which means the US asset manager use green labeling for their marketing, advertising purpose only. And actually monitoring the result does not match their advertising at the beginning. So there are some discrepancy. The information relayed from the asset manager side to the investor side. Next slide, please. Several financial articles indicate that actual green market is different from the fancy promise on the public. One financial article in February 2020 suggests some summary of recommendation. They are first, they need to incorporate climate effect onto rule. And the second is the auditor needed to call out the company, and then take some actions. And third, shareholder needed to vote using the approach in case of the indirect investment. And fourth, largest asset manager had to, their role would be very critical to promote the green bond market. And also the credit rating agency, they have to develop some model to analyze the green impact. Together, all of these above 5, lastly, most importantly, they suggest some business incentive. The Financial Times articles were summarized there, and we are going to briefly look at why and why we need some simple play and reflect. Next slide, please. Conventional capital market investment process, as you know well, is a keep ongoing process, reflecting some change of any financial market factor into the investment policy of the investor. So the fund manager, they are binding to the following investment policy statement. So the fund manager, in processing and selecting asset and the allocated asset, they have to reflect what the investors are requested by law under the IPS statement. But their rules, fund managers' rules, are governed by fiduciary duty, which is the legal obligation, and also prudent man's rule, prudent person's rule, which is also some law legal issue. So so they are not free from the investors' risk return, the expectation on the investment process. However, when you look at the green bond, climate bond side, the investors' IPS does not clearly include some climate factor, and also even the law no mention about some climate issue. And only the moral some responsibility issue. So the investors, so the asset manager usually in between. So they have no choice but to following some conventional process. Next slide, please. Yeah, also pricing concept is also matter. Conventional asset pricing model is based on the historical data with some past normal distribution history. We know that the market return is not only depend on cash flow, which is the numerator factor, but also the central bank interest rate policy, which is the denominator factor. However, in climate change, green bond case, there's no the data and also no probability the data also. So only some the future based scenario only. So without data or some methodology or probability distribution of the record, they cannot price in the bond. So that is the market case now. Next slide, please. Let's look at the pricing of our company, certain company level. In order to pricing, we need a cash flow projection in the future of a company. Usually cash flows are available in the financial statement. However, those cash flows are not climate risk adjusted. And also discount factor also matter. As there is no clear the discount factor for pricing, so this is because of some low data on the historical volatility issue. In terms of the conventional the pricing logic. So and another issue is the benchmark issue either. So all of these case, in case of the green bond case, there's no certain cash flow projections rules and no benchmark yet, even though there is some case, but those benchmarks are not clearly, set up compared to the other conventional benchmark. So some issues still remain in pricing side either. Next slide, please.
13 minutes.
All right, yeah, almost. In conventional, okay, I can skip this one. Yeah, okay, next slide, please. This part, investors' point of view, you know that the investors are acting based on. Okay, next slide, one moment, please. Okay, this picture briefly snapshot of the financial market. Many institutional investors are closely integrate each other, not only on the mutual business interest, but also they are strongly, their relationships are based on very strong document, in terms of law. So in pricing any asset, they also must integrate together. So, but the when you compare this kind of process to the green bond side, you can see many part of process are skipped. Next slide, please. Therefore, based on certain current market issue on the article and comparing it to the conventional market, we need some the necessity of team player, which include the investor, financial institution, financial intermediary, and also the issuing side of corporate, and the setting player, which means that we need some regulation support and the generally accounting impact principle like some guideline. And also investment statement, and also we need some developing some rules to pricing exactly on the climate related green bond. Next slide, please. This is last page. In addition to the suggestion on the article, I want to add first to the central bank support in terms of the pricing and liquidity side, and the government support in terms of tax, and also the private investors incentive, and first, which is most important, the accounting rules, and also lastly, some cooperation between OECD country and the developing country. My last comment is that when you look at in 1933, US adopted generally asset accounting principle, and this increases transparency of the company's profit, and it increases huge financial market. Likewise, in 2020, if we can adopt generally accounting impact, climate impact principle reflected in the financial statement, then that will be, another some key triggering point which increasing promoting green bond market. I think. Thank you. This is all of my presentation. Thank you.
Thank you very much, Dr. William Kim, for your interesting, informative presentation, and thank you for finalizing it within the time. So the final presentation is a joint presentation by Dr. Dong-Kyun Park. Dr. Dong-Kyun Park is currently principal economist. He's currently a principal economist at the Economic Research and Regional Cooperation Department of the Asian Development Bank. And before joining ADB, he was a 10-year associate professor of economics at Nanyang Technological University in Singapore. Dr. Parks plays a leading role in the production of Asian Development Outlook, ADB's biannual flagship publication on macroeconomic issues, and leads the team that produces Asia Bond Monitors. And the second presenter of this work is Dr. Shu Tian. Dr. Shu Tian is an economist at the Economic Research and Regional Cooperation Department, ERCD, of the Asian Development Bank, ADB. And before joining ADB, she was an associate professor of finance at Fudan University in China. Her main research interests including financial services and institution investment and asset pricing. She is also a member of a team that produced Asian Development Outlook and Asia Bond Monitor. Dr. Park and Dr. Tian, please.
Thank you very much, Professor Farhad. Can you please play the slides? Okay, thank you. Thank you. Next slide, please. So the topic of this presentation, which myself and Dr. Shu Tian Grace prepared, is financing a green and inclusive recovery. Of course, the key priority now for Asia and the world is to recover, right? The economy has collapsed as a result of the lockdown and the community quarantine restrictions and all these restrictions, shops closed, factories closed, so the world economy has collapsed. So the priority is, of course, to recover, right? Not to recover in a green and inclusive way, but of course, this focus on recovering in the sense of narrow economic recovery, GDP growth, and so forth, should not make us lose sight of this importance of these priorities that were very important before this coronavirus pandemic broke out, which was to make the world a greener world, an environmentally cleaner world, as well as a more inclusive world, because Asia, as in other parts of the world, was suffering a worsening, a sharp worsening of inequality. Okay, so just prior, at least until prior to this outbreak of COVID-19, there was a clear shift in Asia's focus toward more greener development and more inclusive development. And that was not always the case. In fact, I think it's important to remember that although Asia is now one of the three major centers of gravity of the world economy, along with the US and Western Europe, right? Asia is the third center of gravity, right, of the global economy. Until a few decades ago, we were a typical economically stagnant, very poor region, right? We were, I think, at income levels of sub-Saharan Africa, right? Although that's quite difficult to imagine now. But the point here is that when we were poor, of course, the priority was to grow and grow at all costs. And what that meant was that environment, right? Environmentally clean growth, green growth was not a priority. But that has changed. Now the region is by and large middle income. In fact, more than 98% of developing Asians live in middle income countries now. There are just a few low income countries left. So of course, there's been a tremendous improvement in general living standard, as well as a sharp reduction in poverty rate, right? So now we are in a position, Asia has reached income levels where Asians and Asian governments care much more about the nature or quality of growth rather than just growing as fast as possible at all costs. More specifically, we are paying much greater attention to environmental issues as well as inequality issues. In other words, to make the our economic growth benefit a much larger share of the population, the broader population at large. So this is evident, if you can see in this graph, in the rapid growth of green assets during the last few years. Asia Pacific is the yellow part of this these bar charts. Next slide, please. And of course, this COVID-19, this huge cloud of uncertainty hanging over the world and hanging over Asia has a major negative impact, unfortunately, in our progress toward a greener development and lower carbon development. If you look at the government side, right, a huge amount of public sector resources, right, is being allocated to the fight against COVID-19, usually in the form of a large fiscal stimulus package. And at the same time, this downturn or recession will reduce fiscal revenues, tax and non-tax fiscal revenues, at least for some time, at least until the economy bounces back. On the market side, of course, this coronavirus has, as you can see on the chart, on the right-hand side, has negatively affected the risk appetite of investors in all financial markets, including, unfortunately, ESG segments of the financial market, and to some extent, companies' willingness and ability to invest in green technologies and green infrastructure will also suffer as a result of COVID-19. Next slide, please. So how do we maintain, given the situation of growth collapsing, government having potentially having less resources for green infrastructure and green technology, and also social spending. So how do we maintain the momentum, right, toward environmentally cleaner and more inclusive growth? Well, as a matter of fact, we don't have to be too pessimistic about the reduction in fiscal space due to COVID-19. In other words, it seems to be the case that there is some room, right? There is still some room, even within the fiscal stimulus package, to support green growth and inclusive growth. And of course, one way that government spending, these fiscal stimulus packages, can support green and inclusive growth is by restoring business confidence, by encouraging balanced investments that not only focuses on productivity, but also on environmental impact and social impact. And the IMF notes that even in this current crisis mode, there are still some policy actions for governments can take to support climate goals. And there's not necessarily a trade-off. In other words, you don't necessarily have to, if you support growth, that does not have to come at the cost of environmental issues. And if you support cleaner environment, that does not have to come at the cost of growth. So there are some scope to support growth and support recovery of growth, as well as support cleaner environment. Next slide, please. So more specifically, what are some solutions to financing greener recovery and a more inclusive recovery? Of course, there is some scope for fiscal stimulus packages to support green and inclusive recovery, as I just mentioned. But I think inevitably, financial markets will have to play a bigger role, because fiscal space will, in any case, be limited to some extent, because the key priority, the overriding priority of fiscal stimulus packages is to support the economic recovery. GDP growth, or rather GDP contraction, is like -5%, -7%, -8%. Through massive fiscal stimulus, let's at least lay the foundation for recovery so we get back to a long-term positive growth, positive territory. So it goes without saying, financial markets will have to play a bigger role. Bond issuances, ESG rating, and green and social loans all have a role to play. And also social and development impact bonds and other PPP arrangements that are similar to PPP, and also microfinance programs to support SMEs and the women and other vulnerable groups, and fintech solutions as well. And there are also other possible alternative financing sources, such as carbon tax and the other carbon financing solutions. Next slide, please. And then I think it's important to note that the financial markets do care about climate risks, because environmental risks do have implications for pricing of financial assets. Cost of cleaning up, right? Environmental liabilities. And then firms that show better environmental performance are able to obtain capital at lower costs. And a number of environmental risks, but especially regulatory environmental risks, they can also affect the institutional investors portfolio decisions. Next slide, please. So what are the benefits, more specifically, of these kinds of green and social financial instruments? Well, there are a number of research studies that demonstrate, that clearly show that these kinds of green and social financial instruments, such as green bonds, such as impact bonds, they not only have a positive and significant economic benefit, such as, for example, lower cost of funding, right? Baker and Gianfrati and Zerbib and others, improved shareholder value and equity and liquidity of green bond issuers. And also green bond issuers, they have access to a broader, wider investor base. Why? Because they're able to attract ethical investors, long-term investors, and other investors. So these are just some of the positive and significant economic benefits from green and social financial instruments. But in addition, they also have a significant positive and significant social impacts. But to be fair, to be accurate, the research on social impact so far is much more limited and much less well developed than the body of research on economic impact. But nevertheless, there is some preliminary evidence that does show some positive and significant social benefits of green and social financial instrument. But more research has to be done, and that's what Grace and myself, it's a very important part of our research agenda, especially in the Asian context, to analyze and to do more research on the social impact of a green and social financial instrument. Next slide, please. So unlocking private sector resources via financial markets, via green bond markets, via impact bond markets, of course, that helps to promote green and inclusive recovery in the post-COVID world and post-COVID Asia, right? Governments can do a number of things to help lay the foundation, right? To encourage more participation in green assets. And of course, we can also help develop financial infrastructure that creates a suitable ecosystem for green and the social finance. Under the Asian Bond Market Initiative, we are doing some things. By the way, please don't forget to access the ABO website, Asian Bonds Online website. It's a website that Grace and I manage and run. It's the comprehensive, it's the best, it's the one-stop source of information on emerging East Asian bond markets, Asian Bonds Online. And it also includes a very nice, high-quality research report called the Asian Bond Monitor, ABM. It's a quarterly report. It shows a lot of market information as well as some in-depth research. So again, there's a lot of scope for financial markets to promote a greener and more inclusive post-COVID recovery here in Asia and also around the world. Thank you very much.
Thank you very much. Thank you very much, Dr. Dongkyun Park and Dr. Shu Tian, for your interesting and informative presentation. That was very interesting. So next, we will have about 30 minutes, 35 minutes time for Q&A session. That if there are questions from the panelists and also from the attendees, from the participants, it could be asked. So if you have a question, please use the function of the raise hand for the panelists and also for the attendees. Then for the attendees, I will open the mic, then they can also ask the question. So before that, I have 3 questions that I would like to ask. So maybe it's better to collect all questions and then we have the answer from the panelists that addressed. So my first question is to Mr. Takashi Hongo. So thank you very much for your interesting presentation, especially the risk control checklist that you designed for the COVID-19. That was very interesting. That was from the point of view of the financiers. So what about for the point of view, I mean, from the investors or from the government's aspect? So you mentioned about this checklist and about this matter that the risk is increasing due to the COVID-19, systematic risk is increasing. So what about the de-risking? So what kind of de-risking tools are you proposing currently that could be used for the governments to mitigate the risk? So the next question is to Mr. Cedric Remount. Thank you very much for your presentation. The climate bond certificate that CBI is issuing, that is also very interesting. So I would like to know if, first of all, what I know you showed that matrix that shows the indicators generally, but if you could explain a little more about the indicators that CBI is using for recognizing a project as a green project. And secondly, in the certificate that you are issuing, do you provide green score, or you consider green project, all green projects same? For example, when we are talking about greenness, projects are different from the emission level. Do you consider this matter? Do you give a score, or you don't have any score? And the last question is to Dr. Hyun-Suk Kim. Thank you very much for your presentation, especially about the activities which is ongoing in Korean government. I have a question about the Green New Deal of the Korean government. So in the current time, due to the COVID-19 and the reduction in the global demand for energy, as you know, price of fossil fuels reduced. So even before COVID-19, in 2017, 2018, global investments for renewable energy and energy efficiency reduced. New investments, I mean, reduced. In the current time and in the post-COVID-19, in the era of post-COVID-19, if we continue the low oil price era, it means that the situation will be more difficult for renewable and for green sector. So what are the supportive plans that Korean government has in line with this Green New Deal in order to keep this fragile sector, I mean the green sector, alive? Next, Professor Yoshino, I think you have a question. Do you have a question?
Yes, thank you very much for the presentations. I have 2 comments. After COVID-19, many workers started work from home, and that will reduce the auto riding and so on. So I think if that continues, lots of environmental aspect may be changed. CO2 emission will be reduced. So I'd like to know if this kind of work at home and change, we don't have to travel even this conference. If we traveled, lots of CO2 has been emissioned, but it has been saved. So I'd like to know what will the long line impact of this COVID-19 to many of the speakers. Second one is green bond. I know I mentioned a green bond. From my definition, it is not identical, and there are many kinds of different definitions. So Mizuho Bank accepted my opinion. In Japan, there are 2 government banks started to issue government green bond. One of the bond was one building, which government financial institution is providing loans as emission reduction of CO2. And Housing Loan Corporation started to provide loans to solar power panel on the roof. But I criticize in southern island of Japan, sunshine is very strong. But in northern part, sunshine is not so strong. So same type of housing CO2 emission will be different, but they are issuing same types of green bond. And so I criticize all those sorts of vague definition. So if clear-cut definition of green bond can be exploded to all over the world, that would be the best. So that's why Mizuho Bank was hesitant to participate into green bond. That is my responsibility because I'm a chairperson of Japanese Government Bond Council, and I'm strongly opposing government issue green bond unless it can be clearly defined. So that was my stance. Thank you very much.
Thank you very much, Professor Yoshino, for your comments. So is there a question from a panelist? So or from the attendees. So I received several questions from the attendees, and panelists also answered them in this function. There is a question by Mr. Marshall Mermel. So he asked Professor Kazuo Matsushita. So first, he appreciated your presentation, and he has a question that how best to coordinate this approach that presented by Professor Kazuo Matsushita about the coordination that you proposed. And if there is any other question, and there is one question that I think it's by Dr. Fomin Han of Economic Research Institute for ASEAN. So he asked about the charge of how much it costs to get the green project be certified, any standard for charging, and how long does it take. He asked Cedric that. I think Cedric, he answered this question. So if there is any other question, if there is no more question, then is there a question? No. If there is no question, then I would be happy to hear from the panelists. Yes, Mr. Takashi Hongo, if you start first.
Yeah. Thank you very much. So I think for the financing people and for the industry, this is a very important lesson from the COVID-19. So the first point I would like to say is a kind of approach. So the financial sector is out there.
Your mic is not clear. Can you continue again? The mic was not. Now it's okay.
Okay. The financial sector will ask the industry to take measures to hedge the risk or mitigate the risk. The first one is you should have enough for the extraordinary situation. So you should have more stock.
It's still not clear. The sound is not clear. The mic.
I think there's so many message of my video. So I think the Wi-Fi condition is not good. So I'd like to concentrate on voice.
Yes, yes.
Is this better?
No, it's clear. Yes.
Okay. So again, the financiers and the investor ask the industry to take measures. First one is more contingency reserves. It's a financial option. And the second one is increase stock for and prepare for undelivery situation. And also avoid change the business model, rely on a punctual delivery, like Toyota's Kanban Hoseki. So the business model need to be changed to some extent. That is one of the ways so that
so it's
pardon me?
Yeah, it was not clear. Now it's okay.
Yeah. And about the government action, so the first point I would like to reiterate on the finance and industry should take measures by themselves. But how to support by the government? One possibility is a tax benefit to have enough contingency reserves. And one other way is during the extraordinary situation, the enough the liquidity supply shall be provided to government. So in this case, in Japan, at least in Japan, so far the financial market is not is so far fine, not a serious impact. So the please remember, one of my slides shows the bank lending is increased all the region. So the regional economy rely on a regional bank, local banks. So local banks capacity is very small, but they can provide, they can increase the finance to support the local economy. One of the reasons why is financial market itself is fine. So the my conclusion about the role of the government is possibly the additional measures, tax benefit, and also the very, very important matter is to keep the financial market healthy. That is my answer. Thank you.
Thank you very much, Mr. Hongo. Professor Matsushita, do you want to add? Yeah. Your mic is off. Your mic is mute. Yeah. Please unmute your mic.
Thank you very much for the presentations and the questions and comments. First of all, let me respond to Professor Yoshino's comment concerning the change of lifestyle due to COVID-19, including telecommunication, teleconferences, and so forth. I think, anyway, digitalization is going on very quickly, and COVID-19 accelerated the trend of digitalization, like telecommunication, teleconferences, and so forth. And I think it is very important to combine the state-of-the-art of technology with the objectives of the sustainability and climate change measures without reducing people's welfare. So we can use this trend of introducing or diffusing telecommunication, teleconference, to think about how better improve the lifestyles and work styles of people, including, of course, the gender equality and some other issues, social issues. So I think it is a very good opportunity to think about how to proceed with digitalization with consideration to the reducing environmental impacts represented by CO2 emissions. That is one thing. Another is that due to the COVID-19, there is a trend in many parts of the world to have a more sort of locally produced and locally consumed or local resource utilization, including financing resources. For example, in many parts of the European cities, including in France, bicycles are now becoming very popular. And the local governments are spending more to construct bicycle lanes. Bicycle is a better way to commute than other modes of transportation. So bicycles now become very popular. So I hope financial sectors, people in financial sectors, try to use the opportunity to use financial resources locally and use local resources and human resources, natural resources to circulate the economy within some local region, sort of local ecological economy, may be a better way to avoid both a pandemic as well as climate crisis. So that is my response. And I wonder what was the question posed by Mr. Marshall. He said something like how to coordinate my idea with.
The question is that Mr. Marshall mentioned that his firm meets 14 of 17 UN SDGs, and they are environmental problems such as soil health, air quality, and water problem. He would like to know that how best to coordinate this approach presented by Professor Kazuo Matsushita.
I think there are 17 goals in SDGs, but sometimes there are some trade-offs, and also there are some sort of mutually reinforcing effects. For example, if you improve energy efficiency, you can reduce CO2 emission. At the same time, you can increase job or increase productivity. So we have to think about the core benefits as well as trade-offs in achieving sustainable development goals. And sustainable development goals priority differs according to the local situation, according to the country or according to the locality. So we have to think about the kind of priorities. What is the priority among the various SDGs? So, thank you.
Thank you very much, Professor Matsushita. Dr. Yu, do you want to add something? Is there any comment or not? No? Your mic is mute.
Not much. I'm really enjoying hearing from you about how COVID-19 is related to the green financing and those climate change. Thank you.
Thank you very much. Mr. Cedric, if you would like to answer to the question that mentioned.
Yes, sure. So your question was about whether we have different levels of greenness for the approval of green bonds. The answer is that we don't. Our taxonomy is based on whether the project is in line with the Paris Agreement, which again said that we need to limit global warming well below 2 degrees against pre-industrial levels. So the taxonomy I presented, for each blue dot on my chart, there is a document available on our website, climatebonds.net, that very specifically says what are the technical aspects that the project must meet in order to qualify for a green bond. And this is very precise. And in some cases, for example, solar energy is very simple. You know, it's solar panel and all the equipment that goes with it is pretty well defined. If you take geothermal, for example, scientific experts have told us that we should be careful because some geothermal technologies are actually releasing greenhouse gas emissions. Therefore, there needs to be a threshold and there needs to be a measurement of how much carbon is released. And this is specified in our criteria. For buildings, which is a very big sector as I presented, we rely on the technical standards set by other organizations. Like, for example, in Singapore, we have BCA approved standard. We have the LEED certification in other places. I'm sure in Japan, there must be a building standard as well that looks at the environmental impact of a building. And in many different geographies, there is a body that will look into setting such standard. So our criteria is using this kind of standard and saying, in the current state, let's take the 15% best in class of the green buildings and set that as a threshold in terms of greenhouse gas emission. And from this level, we need to reduce these emissions to 0 by 2050. And this is the perspective that a green building must meet over time to reduce the carbon footprint over time, over the next 30 years, to be eligible as a climate bond. So this is, again, a very precise way of saying or formulating a response to an issue that can be measured by scientific evidence. Climate change can be measured, and the response to climate change can be based on scientific fact. And that's what we are trying to do. And therefore, it's either yes or no. It's not different shades of green.
Thank you very much, Cedric. Yes, the taxonomy that you presented and CBI is following, that is very interesting. So maybe in future, the same way that credit rating companies are doing, and they are measuring the risk of credit finance, I mean the credit risk, and they do credit score or credit rating. Maybe in future, also the green score or green rate be also applicable. Then investors that see that this company or this project that has higher green score or green rate, then they show more willingness to buy the share or buy the financial products of that company.
And indeed, and the data that I have presented to you today, the $863 billion of green bonds that are outstanding, these are green bonds that are aligned with our taxonomy that we have verified, even though they haven't got all the certification, but they have passed our test that we consider them as climate aligned, i.e. they are aligned with the objective of the Paris Agreement. And investors do make a difference. Some investors, for example, in the Nordic countries in Europe, they are very specific that they would invest only in climate bonds. They are very specific in their approach. But there is a little bit of flexibility for investors to consider different types of levels.
Thank you very much. So Dr. Hoseo Kim, so if you'd like to answer.
Hi. I've been working on a Green New Deal, Korean Green New Deal proposal since 2019, right after IMF's visiting to Korea, and the IMF recommended to Korean government to take an expansionary fiscal policy. So last year, actually, I drafted first version of Green New Deal proposal with my colleagues in National Research Council, the member the institute. It's a long story, but I think that it would be a very good opportunity to introduce the Korean New Deal and including the Green New Deal thing, and because the Korean government announced the Korea Green New Deal synthetic plan last July 14. So let me briefly introduce the basic facts of the Korean New Deal and Green New Deal. So yeah, the last week, 2 weeks ago, the Korean government announced the Korea Green New Deal plans, that plans to invest 160 trillion won, 104.1 trillion won worth of fiscal investment to create almost 2 million jobs by 2025, based on two main policies. One is the digital New Deal, and the other one is Green New Deal. So the goal is to transform the economy from a fast followers to a leader, and become a leader in the post-COVID-19 era. From a carbon-dependent economy and to a green economy, and with a society going to more inclusive one. So it proposed 2+1. Let me check the table. The plan proposed has proposed 2+1 policies: one Green New Deal and Digital New Deal, and stronger safety nets, so which will be implemented with strong fiscal support for priming and improved regulations to promote the private sector. And the plan identified 10 projects, 10 major projects, and the total is the 28 projects, 12 for Digital New Deal, 8 for Green New Deal, and 8 for social safety nets. So 3 projects for Digital New Deal is data dam, and AI government and smart healthcare infrastructure. These 3 projects are the major projects for Digital New Deal. And for Green New Deal project, 4 major projects for digital green industrial convergence. It's the green and smart schools and digital twins and digital SOC. Smart and green industrial complexes are 4 projects for digital green industrial convergence. And there are 3 more Green New Deal projects, green remodeling, green energy, and eco-friendly vehicles. These 3 major projects are major projects for Green New Deal. So investment plans is, as I said, the total is the 67.7 trillion won will be invested by 2020, and finally by 2025, the end of the planning period, it will be almost 160 trillion won. So by project, the 58 trillion won for Digital New Deal and 73 trillion won for Green New Deal, 28 for stronger safety nets. Regarding Green New Deal projects, so the projects can be categorized into 4 groups. One is first, eco-friendly infrastructure and renewable energy production. Second is the green transition of infrastructure, including remodeling public buildings and schools. And third, promote low carbon and decentralized energy, such as building smart grids and promoting distributed energy production and eco-friendly vehicles. And the final group is to promote innovation in green industries, to provide in order to provide technology development support for environment and energy, SME, and to build a green industrial cluster to help with advanced technologies and market environment. So yeah, this is the very brief overview of the plan for green stimulus recently published, announced. Thank you.
Thank you very much, Professor Dr. Hoseo Kim. Okay, so is there any comment from the side of Dr. William Kim and Professor Hyun Suk, if you would want to add something? No? Yes?
It's okay, yeah.
Okay.
Yeah, I have a quick comment on the Yoshino Sensei, the remarks on green bonds. Theoretically, we have a varying degree of greenness. For example, depending on how much CO2 we can reduce. But empirically, it is very difficult to measure the CO2 emission reduction precisely. So yeah, if we can measure precisely, we can differentiate many different types of green bond, and it can be incorporated into the bond pricing. Thank you.
Thank you very much. So if there is no more question or comment, then I think we can, yes, please, Mr. Hongo.
Yes, and my question, my concern is, I is divided into 3 phases: emergency, recovery, and growth. So now it's mostly emergency. Next would be maybe recovery, but at that time, many of the companies budget, the financial condition are very much deteriorated. So that means rating of the company is not so good. like aviation companies. So, but the green bond or the sustainable bond, how to use this bond for supporting the phase of the company under the phase of the emergency and the recovery phase. So the case, lending, typical lending, a kind of the coordination work is possible, but the minimum of the case is taking the only corporate risk. I think this is a space for improving the green bond. That is my question. So someone can reply?
Any response from the panelists to the question that Mr. Hongo mentioned? That the policy measures need to be divided into 3 different stages: emergency and the current time, and also the post-COVID. Okay. So if there is no more comment or question, then I think we can wrap up the meeting, this webinar, and I would like to appreciate all distinguished presenters, keynote speakers, and participants as well. So it was a pleasure to have this webinar in the current time, and I think very practical policy recommendations mentioned by the presenters. And I would like to express my gratitude to Tokai University and Yonsei University, especially to my colleague, Professor Hyun-Suk, who was the co-organizer of this webinar, and we worked together. And I hope that from now on we have more events like this between universities and then expanding it with other co-organizers. Thank you very much to everyone, and I hope to meet you in person after this pandemic. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Goodbye.
Bye. Let's go.